Welcome to the Long-Term Investor. I'm so excited today to be joined by Mary Childs, co-host of NPR's Planet Money, and more importantly, the author of new book, The Bond King. Mary, thank you so much for joining me today.
Thank you so much for having me.
Being in finance myself, I'm pretty familiar with who Bill Gross is. And before the show, you and I were talking a little bit about the struggles of writing a book. And I know that you certainly went through some iterations, but Bill Gross, he's certainly finance famous, but he's not necessarily a household name. So when you told people, friends, family who aren't necessarily in the profession, that you're writing a book about Bill Gross, how did you explain to them in terms that they might understand how big a deal he was in the world of finance?
Yeah, I have to say my elevator pitch is still really weak. Like my very brief summary is just like, I can't do it. I have to do the big summary. And so for people who didn't know, I'd be like, oh, he basically created the bond market, and they're like still blank. And I'm like, which is this massively influential market where, companies and governments fund themselves. And there's this one company really in my telling, at the center of it. And, Bill Gross is the center of that. And they're like blank, blank. But I will say, since he left Pimco and Janus, he's kind of done himself no favors in his reputation. And I think a lot of things have happened that he wish didn't, but those were very headline-getting things. He had a very acrimonious divorce, and he's gotten in this dispute with his next-door neighbor, and both of those have made very big headlines. And so over the years, it stopped being me explaining that. People would interrupt and be like, wait, is this the Chihuly guy? Wait, is this the guy who left dead fish in his ex-wife's house? And I'm like, that is the one. So in some ways, he did become a household name, just not in the way that we predicted.
Well, you were covering credit markets at that point in time, if I remember correctly. Yeah. And I love the story of your first interaction with Bill that I guess sort of prompted what came and turned into a journalistic relationship. Can you share that story with the audience?
Absolutely. So I had worked on this one story about CDS and Pimco making this kind of really big trade in CDS. And I did all this painstaking fact checking, and I published the story. But it's one of those things where you work so hard, you kind of lose the forest for the trees kind of thing. And I had made a mistake in like the 39th paragraph or something like that. And so the next morning when the story has been published, Bill Gross is on Tom Keane's show on the radio, on Bloomberg Radio. And he's like, Mary Childs needs to get her facts straight. And I'm like, oh my God, like what? This is how I learned of my mistake in the story. And he's like, oh, Pimco is actually, she said we're underperforming by 1%, but we're actually outperforming by like 3%. I forgot the actual figures are correct in the book, but, and so I'm like, oh my God, I got to fix my story. So I'm like trying so hard to replicate the numbers he said that they were up by 75 basis points. That's what it was. And so I'm trying to replicate that, and I'm like entering it into the terminal, and like, I know how to use a terminal. I've been working at Bloomberg for years at this point. I know how to like do a time horizon. I know what mutual fund share class, like I know how to do this, and somehow I can't get those numbers. So I'm losing my mind, and finally Bill Gross calls me, and he's like, hey, you messed up. And I'm like, yes, I'm aware. Thank you very much. Thank you for, being nice about this. And I'm having this problem. I can't get those numbers that you're saying. You said that total return was up 75 basis points, and I'm still seeing that, total return lost 1% or whatever it was. And he's like, well, you got to say your numbers, I got to say mine. And I was like, wait, what? Did that just okay, he just told a report. There's an interesting power thing going on where like I'm a reporter, like there's a world in which I report that conversation, and I guess I did, 10 years later, whatever it is. And like, it just blew my mind at the time that someone would kind of consciously and overtly say that. But I think that's like so telling about who Bill Gross is and his understanding of the press and of what matters and how to say what you want to say. And he knew that on the radio, they're not going to go back on and be like, correction, Bill Gross misstated. Anyway.
Well, and it definitely, having read the book, hearing that story does make sense. He is someone who is definitely going to push the envelope and be loud and trust that his figure is going to overwhelm. I actually have a lot of Bill Gross specific questions, but just to focus in on you before we dive in deep on that, I'm kind of curious what drew you to covering credit markets in the first place.
Okay, such a good question. And I think I thought that, I have an added nuance since the book has come out and I've had more conversations about this where like, the basic thing that I laid out in the book too is I think bonds are really interesting and influential, and they're difficult sometimes, and they're where some of the more complex financial engineering happens, and they're where rubber meets road in bankruptcy court. It's very often the fulcrum. Anyway, all of these reasons that make credit, I think, very elegant and compelling and fascinating, and kind of this beautiful manifestation of like our societal values and who we prioritize and like how we build a waterfall around that. But someone was like, "Oh, you're just kind of replicating that old trope of bond people think they're so smart." And it's like all these old bond guys at like Solomon who like started that. So I'm like, oh no, did I just play into this like old man, like old boys trope of just being like bonds are smart and stock guys are dumb? And like maybe. So I have to sit with that and let you know.
Well, they all had their different calculators too. They all
Special
used the
calculators.
HP calculator, which I never figured out how to use. And I even know in my first job, the bond guys used that. I used the TI. I was the
Yeah.
CFA. The CFA rooms, you knew who traded bonds and who did not. So
Yeah.
that's always been my tell. And you were really covering bonds at a super interesting time to be covering credit markets. I mean, the whole thing's melting down, and it felt like every Sunday I would open my Bloomberg terminal and see what emergency program has now been announced on Sunday night or Sunday afternoon. And yet, here you are following Bill Gross, who becomes at the center of a lot of things, all things bond trading, because he's so influential to the whole thing, perhaps more so than I even realized
Yeah.
in the moment. In many
Yeah.
ways, your book could be paired with any financial crisis book. But I guess before I go too deep down that hole, I think what made him most famous initially was the sort of popularization of bond trading. It didn't
Yeah.
seem like he really invented it, but he certainly popularized it. Can you maybe talk a little bit about how and why bond trading was invented in the first place, and maybe why it took so long to catch on?
Yeah. So, for a long time, bonds were just certificates that you kept in the basement in a vault, right? And people would clip coupons. And indeed, that was Bill Gross's first job, clipping the coupons at the bottom of the little certificate. And you would send the coupon in an envelope to the literal company, which would receive the coupon and send you the interest payment. Like, that's adorable. But that's truly the way things were. And my theory is that it stayed that way for so long because it worked so well. And, if I'm an insurance company and I have a schedule of liabilities that I know I'm going to have to pay out, having this reliable return of my money when I know that my bond is going to mature, that's very comforting. It kind of offsets the liabilities in a really elegant way, and it's just precise, and you can sleep at night, and it worked. So I think that's part of why it was just so stable. And then Bill Gross and his cohort come along alongside this rampant inflation. And suddenly keeping a bond in a vault and letting the value just erode day by day, that becomes less and less appealing. And this creates kind of a window of opportunity for Bill and a lot of these other people. As you referenced, there was kind of a cohort that came along with him. Howard Rakoff, Larry Fink, even all of these folks that came up in this era. They were like, wait, why are we just like clipping coupons and keeping these in the basement? This actually doesn't make any sense. We should trade them. Like, what if I want to sell this to someone who, has a shorter time horizon or different priorities, and I can buy a new bond that's better, that has, a higher yield because we've had all this inflation, or that has, a shorter time horizon again. It just depends on what you want. And there is this new idea that you can get capital appreciation, that you can trade your bonds and get a higher price, that the bond can go up in price. And this was radical and obviously very exciting. And it kind of made bond trading this extremely profitable, extremely fun, and extremely influential world that where previous it had just been, again, sleepy, steady Eddie, bonds in the basement, clipping coupons.
It's hard to picture, given my investment career, ever going down to the vault to find the coupons the way that Bill did early in his career and tearing them off the page. But what's interesting is even just this morning, I was having conversations with clients on the difference between total return and just interest only. And I think a lot of people watched their parents live off of fixed income, and maybe that's the problem. It's called fixed income, and people think that they're really supposed to live off of it. But there is something that people still struggle to grasp, and it took Wall Street a long time to grasp it. They very clearly understand it now. But the individual investor, maybe millennials, because they will never have portfolios of just individual bonds, whereas a lot of baby boomers did, some Gen Xers did. Maybe we've moved on from that. With Bill, it sounds like once he took hold of an idea like this, he really pushed in the chips. And I know you talk about him being a gambler and loving blackjack myself. It definitely resonated with me when he took a big position and held out. Pimco's position ahead of the housing bubble, for example, took an extreme level of patience. It's one thing to know that something or think something's going to happen, another to place bets in that manner. Can you talk a little bit about how Pimco started making trades in 2006 to avoid what ultimately became the housing crisis?
Absolutely, yeah. So they basically, their mortgage team and Paul McCulley and others saw this, that basically the housing market would not be able to keep going up. That eventually there would be a point at which homeowners would not be able to make their own payments and wouldn't be able to sell to some, greater fool. And that meant that everyone was stuck with these payments they couldn't make, that defaults were coming, that there was going to be this, and I think they didn't predict the severity of the crisis, but they were like, something's going to happen. This is not sustainable. This is not tenable. So they ramped down risk. And that means that, and they were super early, right? Like they were looking at this coming down the pike, as you say, in 2006. So they kind of had to sit there for the duration of at least 2007 and a little bit before that as well, and just wait. And like, that is just so pain. And like investors are like, what are you doing? I'm sorry, you're just underperforming everyone else. Like it was a very go-go time in capital markets. Everyone was, reaching for yield, trying to take on as much risk as possible. Junk bond companies were coming to market, and Pimco was just watching these new issues float down the river without them, and they're like, oh, okay, next time. Like that's just very painful as an investor. And as a client-facing person, you have to just explain away why you think it's the right move. And amazingly, Pimco's clients did stick with them, right? They did say, okay, I'm not obsessed with this year's returns, but we'll stick with you from this 06, 07 period. And it all came roaring back, right? So it did work out in their favor, and they were rewarded for that patience. But that time, as you say, you're not rewarded as an investor for just sitting in cash. You're really not supposed to just sit there in cash and charge fees, right? Like I can do that myself as a client. Like I don't need you to do that for me. So there is this kind of, you have to hope that your client money is sticky enough and that they'll stay with you through this period. And indeed they did with Pimco.
Because being early is the same thing as being wrong. And
Right.
Pimco, it seems like after this call, really started having a lot more thought leadership, or at least I know that I took more notice of it. And yeah, in the way you describe it in the book, it's not just thought leadership in the way that we often use the word, but it really felt like they tried to influence other people's views. And you talk even about the government. There's words like shaking hands with the government and calling the government partners. How important do you think it was to Pimco's success and to Bill Gross' success as a manager to be a thought leader in the way that potentially even moves markets?
I think you've hit on something really interesting, because one source told me I think he put the kind of start date as like 2011, when there was this influx of both money and also talent, people coming from Wall Street, where they'd been laid off at the banks. Banks downsized substantially after the financial crisis and with the advent of, the Volcker rule, et cetera. So all these people came into Pimco, and the ranks, I think, doubled. And that has a lot of different effects, one being that just the composition of the place changes. And this source told me that Pimco started to eat its own cooking, that there was this sense that, yes, we are these thought leaders, that we're right about the crisis, and we're right about housing, and we're right about this, we're going to be right about that too. And this is also under the leadership of Mohamed El-Erian, who's a very macro, top-down kind of economist, right? And so that, I think, also helped to change the kind of texture and flavor of what we're dealing with. I think that under the kind of Bill Gross as the sole CIO, you're very much all about each basis point. You're, fighting with the street to get better execution. You're getting your arms around a credit. You're trying to predict interest rates, but you're putting on strangles. Like everything is engineered and very much in the weeds. And then you have this kind of new advent where Mohammed was the co-CEO and co-CIO, right? And I think that did change the kind of feel of things. And those things combined, you do end up with this like 2011 Treasury call that Bill Gross says, I'm selling all my treasuries. There's 0% treasuries in total return. Like, that's bananas. That's intense. And he was spectacularly wrong. And to his credit, of course, he apologized. He reversed. He still managed to make money that year. But it's just you're talking about like basically in blackjack, knowing when to bet, knowing when to get in there and to put all your chips in and when to back off. This was a moment where he thought he had the odds. He thought that, and it is like, did he think that that by virtue of his call, his own call, it would kind of move the market for him. That like so many people watch what he did and what Pimco did, they would all say, what is the beach doing? The beach is selling this, the beach is buying that. So maybe it got in his head that, oh, I can influence the trajectory of the treasury market. I mean, that sounds like a tall order, but of course, these were very heady days for Pimco, so maybe. And yeah, I think it does speak to this kind of this change in direction and kind of drift from what they had been and what they had always done. And I do think that that's you start to see the seeds of everything coming undone then.
Well, it's interesting that Treasury bet that he made, betting against U.S. Treasuries. And for those listening who don't remember, there was a lot of speculation that the U.S. debt would get downgraded. And it did get downgraded. And it's one of the examples I cite frequently in talking about how you may know about a macroeconomic event or geopolitical event, but you don't always know how the market is going to react to it. And, had Gross not just been right about, hey, they're going to get downgraded, but had he also been right in what would happen with price, it sort of makes you wonder if his story would have ended differently. I mean, from your perspective, and you tell the story beautifully in the book of the spectacular blow up that was Bill Gross, both in his bets and in his interpersonal relationships. But also he sort of seems like the type of guy where if he's a gambler, that eventually he would have made a bad bet and eventually things would have blown up differently. How do you feel about that?
Oh, I don't know, man. Like, if you think about the strategies that he learned in Vegas, the blackjack strategies, he's always operating under the Kelly criterion, right? He's not betting more than 2%. He knows when the odds are in his favor and to bet proportionally more, right? And to always avoid ruin. So, there's another fund manager who in the book talks about his strategy, which I absolutely love. And he called it strategic mediocrity. And it was this idea that if he wanted to be the best fund manager over a 10-year period, he had to not be the best fund manager in any one year. So if he's the best, if he's ranked number one or even in the top decile, he basically extrapolated from these simulations that he ran that realized that he would have had to have taken too much risk, that in some way he just got dumb lucky and got to the top of the rankings when by this, had the winds blown a little differently, or to your point, the market reacted a little differently, he would have been last. So all you need to do is avoid ruin and stay within that kind of middle band, upper middle. We're not trying to like fleece anybody here, but upper middle, and not get blown out. And then over 10 years, you have made more money for your clients. You have been the best bond fund manager or whatever, but it's all about that strategic mediocrity. So I view 2011, and then, 13 is a different story, but 2011 is a bit of an aberration for me in my mind, where Bill did something that was kind of uncharacteristic. And I don't know what that indicates about necessarily his state of mind or how he was changing as a person or as a risk manager. But I do think, people at Pimco were like, whoa. And everyone pointed to this. They're like, find out what happened, like talk to the risk manager for that year, like see what happened. Because these, there are bounds, there are reasons why these things aren't supposed to happen. There are people that are supposed to say, excuse me, you're not supposed to like go to zero. This is an insane amount of risk. So I don't know. I mean, then again, you saw this manifest at Janus as well, where he was swinging for the fences a bit more. But in that case, that one I understand, that one I can like contextualize a little bit, where he was in this kind of emotional battle with Pimco, right? And he wanted to show them that, that they'd missed out on a good deal, that he was the bond king and that they were wrong and they were, he had made them be great and not the other way around. So that makes sense to me, and it doesn't totally qualify or count to me as an aberration from his risk management. But 2011 is. So I don't know. I mean, I think you're right that like if you erase that from his record, like what are we left with? We're left with pretty good risk management. Like did he push the boundaries? Yes, absolutely. Was that what people wanted in a mutual fund? If they'd understood it, maybe not. I mean, I think they all loved their returns for all those years, but like it was a bit more than I think people realized. He was always swinging for the fences, and it got more. We've certainly seen that over the years it got to be more, and the volatility increased. But 2011 is such an outlier to me.
Well, and it's interesting. You talk about swinging for the fences, which in bonds means something entirely different than in stocks. And then the thing I love that you just said is if the clients even realized it. Because one thing that you make very clear is that some of the trades that Bill and his partners at Pimco were putting on were a bit sketchy, right?
Yeah. Well, yeah, sketchy is one way to put it. I think that a lot of them, people have been surprised at the extent to which some of these trades were like self-actualized, like that they weren't just sitting there. Pimco had to basically construct the circumstances that would make the trade win. And, you see this in my very favorite episode, my favorite trade in the 1983 Ginnie Mae CDRs, in which Pimco basically cornered a market and broke the contract because they just bought up so many of these contracts, and the contracts had too many different kind of levers to pull within them. And by buying up all the contracts, it like revealed this like fundamental flaw or multiple fundamental flaws in these contracts. They broke the contracts. They don't exist anymore. And they basically had to make that happen. So they had to go to clients. And like at this time, futures were not, this was a futures contract. They were not really a thing. Like people didn't use derivatives in like pension funds at the time. And they had to go to individual clients and say, hey, do you want us to do this trade? It's a really good trade. You're definitely going to make money. And the clients were like, I mean, all right, sounds good. Like a lot of clients did sign on, and to their great benefit. But it is a bananas moment where you're like, you're opening the door to this like long running and like this is way more risk than a lot of people I think meant to sign up for. It worked for a long time. One fund manager recalled clients, a consultant calling it gross cash, i.e. like we have no idea what you're doing, but we love it. Keep it up. Whatever it is, just keep doing it.
Well, it's a great example also of how individual investors, they may realize that the professionals know more, but they also don't realize the lengths that professionals go through to find arbitrage opportunities, to find additional profits. And it's very clear that, they read deep in the legalese of all their contracts to make as much of an advantage for themselves as they could. One thing that seemed kind of interesting to me is as the book progressed, it was kind of like a slow replay of a car crash in the way that Bill's life unwound. Is there a point when you were writing the book where you're like, hey, I'm pretty sure the story's over, and then it just kept going?
Yes. When I started this, I was like, wow, what a nice, tidy narrative. The rise and the fall. He leaves Pimco, he goes to Janice. And like that I thought was the ending. And I thought that, it's like very narratively neat and tidy and like compact, and there are morals. It's all very good from a story perspective. And it got messy. Like it just kept, and then, okay, it took me too long to write the book. So now I got to write about his like tenure at Janice and all that. Okay. Now he's got this divorce. And at first I was like, I don't really write about personal life things. I'm not trying to muck around and like hurt anybody here. But after a while, like I was saying, I'd be at dinner parties and people were like, oh my God, that's the divorce guy. And I couldn't just like scrub that from his public reputation. You know what I mean? I can't write a whole book about Bill Gross and leave that out at that point. So I was like, all right, I gotta do that. And then the whole neighbor dispute, like, yes, every time, he kept doing things because he is this like very, active, vibrant person, and he's retired now. So I think he kind of doesn't have, the same competition to play in. Like he's missing that sandbox that he used to play in. This is total speculation on my part, but I think that like without that benchmark to try to beat, he's just kind of bored. So he's just kind of messing with his neighbor, like he's just got too much time on his hands. He needs a benchmark.
Well, it certainly paints more of a picture that I can imagine getting picked up by a movie studio or Netflix to make a series out of. So maybe we'll get to see that. I'm going to kind of move off of the book for a second and just tap Mary, the credit analyst, the credit reporter, even though you've kind of moved on to some extent. But looking at bond markets today, I feel like that it's arguably as interesting as it's ever been in my career, in part because interest rates are low, in part because of the inflation. What do you feel like is the most interesting aspect of the bond markets from your perspective today?
So many different ways to go. I mean, you're right. I think that like it is a new paradigm, right? We haven't seen inflation like this since Bill Gross's career began. So, we're taking it back in a way, and that's really upending a lot of assumptions. And it's environments like these where you see those flaws. Like I was talking about that contract that broke. We have made a lot of assumptions that we don't know that we've made because of the interest rate environment that we've been living in. And yes, we've had a couple blips here and there, and it's not been a completely steady ride down. But at the same time, those kind of cracks in our assumptions and our logic and our engineering and our modeling, all of those really start to show when interest rates change and when you have a change in the inflation. And, COVID definitely revealed a lot of these assumptions in its own way. And this is, sort of more broadly. So, just-in-time inventory, suddenly we were like, oh, that may have been not the best idea to do so ruthlessly and so effectively. Like very good when things are working and so friggin' horrible when they're not. Okay. And so the same kind of happens when you actually finally, for once, get kind of persistent and high inflation and rates go up. Like, I think the behaviors of a lot of things are going to start to kind of go upside down, and we're going to see a lot more disruption, for lack of a better word. Sorry, 2014 calling. But I feel like that is the kind of, it's also a moment for innovation and for like new Bill Grosses to be minted, And I'm not necessarily convinced that like the bond market is where we're going to get the next Bill Grosses, right? We kind of already had our heyday, but it is ripe for all these we have new problems to confront, and we can make new things. And that is one of the things that I love about financial markets in general, but also especially about credit markets. There are just so many ways to express opinions and forecasts and like to build things for that. So kind of a sad, it's kind of an embarrassing answer, but I feel like I'm excited for the new products to be invented. I don't know.
There's always innovation in fixed income markets because they're just legal contracts, and lawyers
exactly.
get paid a lot of money to learn how to do special things. So I don't disagree with you. I'm not sure the end consumer will know the difference.
Fair.
But,
Fair,
I mean, maybe with LIBOR
is
retiring, that's an area of the market that's different. But I don't think anybody...
So fun.
I don't know if people notice that or not. Maybe they'll notice when they get a floating rate mortgage or when they take a commercial loan.
Yeah, I think it does filter through. It's like that scene in Devil Wears Prada about like the blue sweater, where it's like she's not actually aware, but she's wearing the sweater. So like she doesn't know that the fashion world dictated 8 years ago that she would end up wearing that specific color. But like you see the change in how we consume adjustable rate products after the financial crisis, right? Like we all know better. We all know about like ballooning and ARMs, and we all know that can come back to bite us. We collectively learned. So there is kind of and like, I remember when Marcus, the Goldman Sachs retail arm, started offering like actual yield on a savings account. People in my generation, we were like, you can make money just because you have money. Like the money. Okay, wait. So then you don't do anything. It sits there. Okay. And like, that was confusing. We'd never experienced that. And of course it went away right away. Now it's like trickling back, but there is this interesting, like psychological effect of like excitement and this collective learning where, maybe people aren't going to be like, wow, this, exchange traded note structure. No, absolutely not. You're right. But there will be some kind of, the end users will feel something in some way. They'll be, they'll have a SOFR student loan debt instead of LIBOR or whatever it may be. And also there will be kind of exciting. Now I'm all hyped. Now I'm like, what's going to happen? Like, this is going to be fun.
We'll have you back in a year to talk about all the
to
innovations that have come to the credit market and the fact that we maybe earn almost 1% on our checking account someday. That may take more than a year,
Are you
actually.
kidding me? Yeah.
It'll be weird to make financial decisions as a millennial that I have to think about the opportunity cost of cash, which again, baby boomers are probably chuckling to themselves saying, I remember when I had my double-digit mortgage. And, who knows that we don't get back there again trying to fight off inflation this time. But we'll save that conversation for next time, Mary. I know that your time is very valuable. And so I want to ask you just kind of a few closing questions that I ask all of my guests. The first, and this is pretty broad, so go whatever way you want, is what are some of your favorite finance books?
Oh, okay. I actually just wrote something for LitHub about my favorite, like, halfway non-finance books. So some of them, it's like books that read as regular, like books, or finance, like if they're finance books that are as fun, or regular books that are secretly finance books. So I'm going to go with Severance by Ling Ma, is a book about, I don't know, like a pandemic. So I apologize, but it's a worse one than we have, which I find comforting. And it's actually about the global supply chain. And like, it predicted in great detail. Like I just found it very prescient. So it was published, I think 2018. So that's one that's like secretly about macroeconomics. The Cop-Out Answers, The Big Short. That's actually not even what I meant to say. The Cop-Out Answer, the one that I feel like we all, it's not even a real answer, is Liar's Poker. Benchmark, gold standard, can't say anything new about that. Let's see, what else was on my list? I've said this on other podcasts, so I apologize, but I have been enjoying reading Where Are the Customers' Yachts?
Oh, yeah.
An absolute classic, but like it's sort of confusing. It's a bit disorienting because literally nothing has changed. Not one thing has changed. I haven't read this one yet, so I'm about to dig in, but Undiversified.
Oh, I've not heard of that.
This is, I just met the author, Ellen Carr, but it's basically about the big gender short that investment management is structurally underweight women. And we could add a lot of other kind of ways in which it's short identities and different classes of people. But basically the investment management in particular has a woman problem. And I haven't read it yet, so I really can't speak to it. But diversification is a core principle of investing, yet money managers have not applied it to their own ranks. And I think this is like one of the great arguments where like people look at numbers of, people are like, oh, it's a meritocracy. And you're like, you have to know what you're saying, right? If you think that it's really a meritocracy, like, and you look at the numbers, like, can you sit with those two thoughts at once and tell me what happened?
Well, I'll say we take great pride. One of my closest friends in our office is our chief talent officer, Amy Jones. And I think when she talks about addressing the gender issue, it's that you can't just say, well, there are no women with an economics background or a financial planning background. You just have to go out for other majors and find smart people. And ultimately, a lot of what makes a really, really good financial advisor is someone who listens well. Now, you're talking, and I'm assuming the book is talking about true investment management. So those sitting at the investment committee table, managing the fund. And again, I'd still argue you don't need a finance background. To my knowledge, the new CIO at Yale's endowment, for example, I think is a history major. So you don't have to look to the traditional spaces, but I appreciate you sharing all those books. I will, for all those listening, be sure to link them in the show notes at thelongterminvestor.com. Mary, one last question. What does it mean to you to be a long-term investor?
I'm going to take it back to the book. I'm so sorry. Everything goes back to Bill Gross.
That's what we're here to do.
Yeah, good. Thank you. The thing that I learned from writing this book and from thinking for so many years about Bill Gross's strategies is I find it very admirable that like he did have these insights into market inefficiencies that were robust and, persistent over decades. And it's mind-boggling to me to think that he knew these things were things and he would come to the table every day fresh and just stick to it, even when things didn't go in his favor, right? So that knowing that your strategy is good and that it's going to work out, even if it didn't work today or yesterday or for the past month or God forbid for the past year, like knowing that you still have a good strategy and you just need the true odds and you need to avoid ruin, that's all you have to do. Like that's really hard because when do you know when the world has changed? Like no one's going to call you. No one's going to tell you that your strategy stopped working. So I don't know that like finding that signal is impossible. And I know that everyone thinks about this in investment management, but to me, the long-term investment, that says knowing you have a good strategy and knowing to stick with it.
I love that response. Mary, thank you again for joining me. For all of you listening, for all of you watching, go check out Mary's book. It is fantastic. I also bought the audiobook just because you do all this podcasting and I wanted to hear how your cadence went, which is a new practice for me. I'm buying audiobooks plus normal books for anyone who's normally a podcast. And so people who enjoy listening to you on Planet Money are going to love listening to you on the audiobook as well. Everyone, again, thanks for joining me. And until next time, to long-term investing.